Welcome to SoapBox, the group therapy session for the UK advice profession, disguised as a podcast. It's Advisor 3.0 SoapBox edition. Welcome to SoapBox, ladies and gentlemen. Welcome to our very first episode for 2026. I hope you've had a great start to your year. Now, on the show today, of course, I've got two very, very important personality, my co-host, the high priest of flat fee financial planning. I don't know why he's chosen that altar to die on. I'm talking about none other than Matt Picha, managing partner at Alto Wealth. And then, of course, we have got a very, very special guest. She is the queen, the Cleopatra of professionalism, the champion of our professional body. I'm talking about Carla Brown, who is the president of the Personal Finance Society and, of course, the CEO of Oakmare Wealth Management. Gents, welcome to the show.
Happy New Year.
Happy New Year, and wow, what an intro.
Happy New Year, Carla. All right. Okay, so we've got a couple of topics on the docket today. Where do you want to start? Matt, this one is one of yours. You got a Christmas present from the HMRC.
From the taxman, yeah. Look, I don't know if everyone listening is going to have suffered the same Christmas I did or whether everyone just took time off and therefore had a much better Christmas than I had. But goodness me, so the taxman comes out in mid to late December and says, actually, we require all of you to register discretionary trusts with a discretionary investment management mandate within it. So any trusts that are using Timeline, Abraham has to pick one of others that are available. And so the deadline is December. So you basically got 2 weeks, of which a week is missing for your Christmas holiday. So unfortunately, I hadn't taken any holiday other than the standard 3 bank holidays. So my goodness, I just share the pain of anyone, accountants, solicitors or financial advisors who were in over Christmas busily registering 50, 60, 70 trusts as we were. And a big shout out to my entire team who pulled out all the stops. Most of them, some of them had been clever enough to go off on holiday before the HMRC announcement to actually do this for them. But yeah, my goodness, what a mad system we're in for regulation sometimes.
Carla, did you get this, or do you know anyone who got this?
It wasn't something that affected me personally, so no, it wasn't on my radar.
It's interesting.
Oh, Merry Christmas to you, Carla. Well
I had a lovely Christmas, thank you.
Yeah, no, that's interesting. Just by the way, is this a new piece of rule? Is this a new set of rule? Or is it that, in fairness to the HMRC, they've made these rules, you've just not been aware of it, and so yeah, I'm being mean here.
That's throwing me under the bus. Yeah, so these are new rules. It's more disclosure for the US, to be honest. Do you know what the UK are like? We'll roll over every time the US tax authorities ask us for additional information. It was announced in July, but it was only clarified in late December that for these particular clients, these trusts that use MPS portfolios or discretionary managers were included. So all the big accountancy firms, law firms, all missed it because it wasn't clarified until late in the day. And so 6 months probably felt like a reasonable amount of time to the revenue. It's not really a reasonable amount of time when you clarify something with 2 weeks to go. But I mean, I would worry maybe some of your advisor clients, Abraham, haven't even picked up on this yet. So there are fines if you haven't done it by the 31st of December, although whether they'll levy them, I don't know.
It's interesting. I have had another advisor pick this up, but just the one. Clearly, everyone is doing such a fine job of this.
There you go. See?
All right. On that cheery note, let's move on to something more uplifting, shall I say. Carla, the PFS is doing a lot of work bringing young talent into the profession. Tell us a little bit about that.
So this is a really exciting initiative that we launched in July last year called Pathways to the Profession. So we've identified that, and it's not news that we've got a declining younger membership base. We've been really successful in getting our membership more qualified, so going through charter, going on to fellow. So membership at those areas has increased. We've got a real shortfall in younger talent coming through. And so, for the full advice profession, this is a real problem because, thinking about succession, who's going to look after our clients further down the line, we need to make sure we've got this young pipeline coming through of talent. And it's also about, once we've got the talent, how do we retain them? Because we're seeing as well, a lot of people coming through academies, getting out into the real world and then becoming disillusioned and leaving. And people have spent a lot of time and effort training and then going off. So we want to make sure that we're bringing people in, bringing the right people in, but also that we're keeping them in the profession once they get here, because that's going to be crucial to the future of financial planning. So the pathway, basically, we announced this £1 million investment in July last year. We've already deployed £500,000 of that with various initiatives. Some of those with charity partners, with Coventry University, put money aside to pay for 500 new members to take the first RO exam. So really trying to get that sort of inspiration to get started. We don't want cost to be a barrier to entry. And we've got another £500,000 to deploy. So we've been asking members for ideas as to how we can really make the most of this money. What do they think would make a real difference to the future of the profession? How can we get people in? And we've had some fantastic suggestions. It's actually going to the board meeting next week, so that's going to be the end of January, and hopefully we can make some decisions then and start to announce those over the coming weeks. But we've already seen, year to date, we've had over 600 expressions of interest in the free RO exam, which is more than we allocated, but I'm sure we'll find some extra money somewhere for that. And we've had 200 new members as a result of the initiative. So it's fantastic starting to see that talent coming through. But my dream has always been that, people come out of an education setting wanting to be a financial planner, because historically people have just fallen into it. I'm sure the majority of us just kind of fell into it. But young people don't necessarily recognise it as a career opportunity. So I'm really keen to reinvigorate the education programs that we've got, getting out to careers fairs, really talking about what an amazing profession this is and how you can make a real difference to the general public's life just by getting involved, by taking that first step and, becoming a financial planner.
Incredible. Matt?
Yeah, brilliant. I mean, well done for investing that much money in something I think we've all been aware has been a problem for a long time, right? I've been doing this 25 years, and it's always been the case that the average age of advisors has been sort of worryingly high. And I don't know why it hasn't in all that time sort of averaged up, but it does seem to be pushing the wrong way. So new entrants into the profession is hugely needed, and there's different routes. I mean, this initiative's great. We've done a bit of CII Connect mentoring in the past, or I have. So I'm hoping that'll be refreshed as part of this. Is that part of the plan, that you're sort of tackling it from lots and lots of different avenues?
Absolutely. Yeah, and just going back to your point there, I saw a stat this week, the average age at the moment of an advisor in the UK is 58. So, we definitely need that younger blood coming through. And it's not just about young people, it's about, second careerists, people returning to work. So, yeah, we're looking at lots of different angles. We're looking at apprenticeships. I think that's really key. You don't have to go to university to be a financial planner. There are alternative ways of entering the profession. We're looking at, internships. It'd be really good if we can get firms to agree to do paid internships. We don't want barriers to entry. And for some people, they can't afford to not earn while they're learning a skill or a craft. So if we've got, members out there who can offer paid internships, that's a really great way to get people into the profession. We're looking, as I say, at education. We're looking at social mobility. We're looking at, how can we bring in a more diverse pipeline of talent as well.
Yeah, that's brilliant. I mean, we're very fortunate. We're near to Reading University, and they run internships twice a year, and they fund half the cost of those, which is brilliant. So we've had several of their students through the firm, just learning a bit more about financial services, how it works. not managed to convert any of them into financial planners yet, but a lot of them come through, first year or second year of university studies. So they're quite early. They're exploring all their options and they're not quite ready for a career yet. But it's a fantastic way of doing it. It's a really good point, actually, about career changes. So 3 of our trainee advisors or newer advisors were career changers, all in their 30s. So they've all had a 10-year career at something else. We had an accountant, a police officer, and a NHS worker. So they've all been used to a work environment, to a workplace, and how that operates before then wanting to transition. They've all decided they've all found financial planning off their own back, which actually is incredibly encouraging. So there's clearly enough out there that people are being attracted. Whether there's enough, I think you're absolutely right. I mean, what we do is possibly unusual as a firm. I don't know for a firm of our size, but there probably is a limit of demand on the advice firm side. Is that what you're finding? Are you finding more firms engaging, or are they?
We are finding more firms engaging, but we're always looking for more. So in my business, we always take in work experience. We've got graduate trainees. It's about creating a framework that will allow somebody coming in fresh to the profession to understand what their journey is going to look like. Because at the moment, we haven't necessarily had that framework. I mean, we have the PFS professional map, which talks about the behaviours and the qualifications that you need to carry out certain roles within our profession. But it's about having that sort of each firm. If a firm can have a robust framework where you say, okay, you're going to come and join us on day one, and within 5 years, you're going to be a chartered financial planner, then that's great. That's something somebody can work towards. And that necessarily hasn't always existed. And I think you made a really good point there, Matt, about mentoring, because that is so important. It's not just about exams. It's not just about being technically competent. That is not necessarily what makes you a fantastic financial planner. It's about all the other skills that go alongside as well. And we have that, we do some education through PFS Power on that. But I think mentoring is a great way for people to understand exactly what our job entails. Because, when I go into university settings and talk to them about what I do on a day-to-day basis, they can't comprehend, you mean you're not sitting in front of a screen all day analysing numbers? It's like, no, that's not what the job is. It's actually getting out there and talking to people. And, our tagline for the Pathways to Profession initiative is invest, inspire, involve and inform. We're looking to invest money in the future. We're looking to inform people about what a career in financial services actually is. We're looking to people to get involved. So this is, members getting involved, employers getting involved. Can you offer space in your business to mentor or to take on work experience or internships? And then inform. So informing not just potential new members, but also the general public about what amazing work we do. Really good role models out there who shout about what a fantastic career this is.
Yeah, brilliant.
That's incredible. I mean, I think it's great to see the starting point. I'm about to throw rocks, but the starting point, it's great to see the PFS, after, quite some criticism recently and all that stuff in terms of money and how money is being spent, to actually be making a bold statement with this investment into professional development of, and I consider this like an existential crisis to the profession, really. A couple of things. So there's a questions, Mama. So there's £1 million dedicated to this.
Yeah.
And this idea of, what do you call it? A number of RO1 exams, the first exams.
RO5 is the one that we're suggesting people do first.
That's interesting, right? AY. How many of this has been taken up? And frankly, if I can push a little bit more, why not make some sort of first exam that you do to get into financial services free to anyone?
Really good point, Sir Abraham. I think why RO5? Well, if you've sat RO1, you'll understand what we do. Put that one out there first. It's possibly the driest topic that there is. RO5 is a bit more of a, something you can get your teeth into. And, we've had 200 people who've signed up to actually have committed to going through this, because as well as offering a free exam, we're offering free membership as well. So we've got 200 new members who've actually committed to do the exam. We've got 600 expressions of interest. So there's some of the pipeline we're following through. And, this is £1 million initial investment. There is potentially more money behind this as well, but we need to make sure this is working. Though, it would be ridiculous to throw everything at the wall first of all and see what sticks. We need to look and say, okay, this is what we're investing. Is this actually generating the outcomes that we want it to? So we've got KPIs in place so we can measure. But, it's no secret. we have money that we want to invest in our members and the future of the profession.
Absolutely. Sorry, a bit of, I'm going to blow smoke up my own bum here, which is that, so I really think this is important. And shout out to Dr. Liu at Coventry University.
Yeah.
I remember sitting on a table, I don't know, must be 18 months ago with some leaders within financial planning, community. And we were talking about how do we actually create this pathway, make financial planning an option that people consider at university level and indeed as, career, options, especially even at secondary school level. And two things came out of that, Timeline and Brett Davison, a couple of people decided we're going to sponsor scholarships, right? So that's going. We actually have the first Timeline scholar. We're paying the full university fees, and I like the way Coventry University is doing this in the sense that they are making winning this scholarship a competition at secondary school level. Yeah. So, they go around the country, they interest parents and of course students in competing for that scholarship place. And, they've seen increased application to the program, even though they're only given a handful of scholarships. So that's great. And in that meeting, I remember saying to them, I will pay for 30 students at Coventry Universities to take the R01. I take your point. R01 isn't going to be the first one that you take. But I said, I'll pay for the first ones, just pay for the exam cost or whatever. And this money wasn't being spent 6 months later or whatever. And I remember Dr. Liu came back to me and said, actually, Abraham, we're going to spend that money on something else because the PFS has decided to make that exam free. To my mind, there is absolutely nothing for us to lose as a profession if we just get a bunch of people, give them a taste, into what this profession is about. I don't know the best way to do that. Internship, of course, it would be great. I see the work that you're doing, Matt, with career changers, coming to your firm and seeing, 3 advisors who have come from a completely different background. We just need to throw the kitchen sink at this, I think. Yeah.
I completely agree. And Dr. Liu is absolutely incredible. She's so inspirational. And we've also, as part of our Pathway initiative, we've sponsored 2 scholarships in the same program at Coventry University, and that process she goes through of raising awareness through the secondary schools is fantastic. And in fact, one of the things that we're looking at the PFS is potentially introducing a national competition for schools as well. So really trying to get schools up and down the country involved in this as well, just to raise awareness of exactly what we do.
Yeah, that's fantastic. Sorry.
I was just going to ask Carla. I mean, obviously, the financial advice profession, because it's great to put people through the qualifications. Clearly, you need the jobs at the other end, and probably need some of those early stage jobs. So not the full blown advice jobs necessarily. Our profession is largely made up of small, medium size practices where probably we don't have the resource and the time to develop a program ourselves. What can the PFS do to help firms give them just a structure to kind of make it easy for us selfishly?
Yeah. And that's a really good point, and one that I'll take back actually, because at the moment that framework outside of the professional map, that framework doesn't exist, but maybe we do need a kind of, off the peg. This is what that could look like. We're all looking for streamlined ways to do things. We want as little friction as possible. So if we as a professional body can do something that's going to make that transition or that line of work easy, that's something we can take back. So I'll absolutely take that away with me.
Yeah, that'd be amazing. I just, I always worry with these things. You've got hundreds and hundreds of firms throughout the UK reinventing the wheel when you guys have probably already built it.
Yeah. No, take that.
Fantastic stuff. So let's move on to my favorite topic. And I'm gonna put, these are various news headlines, but that I am putting together into one. So basically, last year, our dear British investor essentially fled the stock market at a record rate. So in 2025, British investors pulled a total of £7 billion net from the equity market. That money went into cash, fixed income products. Some went into multi-asset funds, but essentially we pulled money out of the stock market. And when you look at the month by month flow, you saw there was net inflow from equity, net outflow from equity in January, and then February, March, April was fine somehow, and then from May through to the end of the year, we were pulling near on 800 million, some month a billion net from equities. And what did the MSCI index do in 2025? 14% return. Even our forgotten, I want to say, FTSE 100 reached a new all-time high, 10,000 points. First thing in January. What the heck's going on?
Yeah. I mean, it's classic emotion-led decision-making, isn't it? And I think it just highlights the need for, advice and planning, because people will often struggle to act rationally when left to their own devices.
Yeah, no, you're 100% right. I mean, I think there's probably too much information, not enough wisdom, frankly. We're bombarded. We all are, and we can all be susceptible to it. We're bombarded by messages all the time, aren't we? That, there's going to be the next big collapse or a tech bubble burst or AI bubble burst or whatever. It's just this constant flow of, it's not even really news anymore, is it? It's just opinion that arrives on the phone, on the laptop constantly. I suspect that's a lot of what's behind it, because I'm guessing these people didn't all have fixed expenditure, fixed outgoings, plans for that cash. They're just responding to what they're hearing. Because it is insane, isn't it, to be pulling cash out of a market when the market's on an absolute tear. It is mad if you're a long-term investor. It really does worry me.
How do you is this something that you do, evidence or demonstrate that this is one of that just invaluable value of advice? How do you say to clients, look, this is why you're paying me? How do you even quantify that to say, investment returns are lumpy. There are going to be these periods of just constant temptation, from deluge of news coming at you. But if you stay on your seat, frankly, paying me 80 basis points, 100 basis points a year is nothing compared to the money that I will save you from making these silly mistakes. Does this even come up in your conversation with clients?
Definitely. And, unfortunately, people tend to sell fear and buy confidence, and unfortunately in that order, don't they? But these absolutely conversations I have with clients when we very first take them on as clients. It'd be really interesting, and the stat probably exists somewhere, but it'd be interesting to know the people that pulled money out of the market, were they DIY investors or were they advised clients? That would be really interesting to know, because our job is more about behavioural coaching than anything else these days, and it's trying to stop people making those expensive mistakes.
Well, we don't have that level of granularity, Carla, unfortunately. I agree with you. It'd be incredible to have. What I do know is that active equity investors, the people who pay fund managers to navigate uncertainty in the market, net pulled, you sitting down, £0.9 billion from equity funds. Index investor, on the contrary, net actually added £12 billion of inflow. So you saw £12 billion going into active equity funds, near on £19 billion of outflow from passive equity funds. The net, i.e. 6.7 million equity fund of outflow in the equity fund, essentially is from the active side of things. So my point is, we don't have that level of disparity between advised and non-advised. We do have at active. Is that a way to get active versus passive debate started? Not necessarily. I'm just looking at the numbers.
Yeah, I mean, and those flows from active solutions to passive solutions have been billions, net, haven't they, for years now? I remember looking at these kind of numbers a decade ago, and you had that kind of outflow from actives and an equivalent inflow into passives, and that's fantastic to see. And I'm sure that will carry on. The worrying bit is the move to cash. And to be honest, it's the bit in the middle that's getting lost through that churn. That is the worry. I mean, look, at the end of the day, all of us on this call, we are serving a small percentage of the population. And I'd like to think, Carla's right, I bet the platforms have some of this data, actually, particularly the ones that have got direct-to-consumer arms and advisor arms. I'd like to think that the advised portion of the population have remained invested and will remain invested until they actually physically need the money for spending it on something. But by volume, it's the majority of investors that are behaving like this, because by volume, it's the majority that aren't getting advice, unfortunately, until we can find a way of bridging that gap. And I don't know that that's arrived yet, but until we can do that, and maybe that's technology, maybe that's loosening of regulation, we can talk about that today. Maybe we can start nudging a broader section of the population into staying invested and staying the course.
Do you think this, potential incoming rule change to limit things like cash ISAs, I mean, do they make any difference to this sort of thing? In other words, I don't want to use the word forcing people or, to invest in equity. I don't know. Does that make any difference to this in your mind?
Certainly with my client base, I'm not seeing it make a huge difference at the moment. Most of my clients are who have significant sums invested, probably over 65 anyway. So the changes that have been brought in haven't really made any difference. It's about the message that's getting out there, isn't it? It's very well encouraging people to invest, but it's allowing them access to advice to be able to do that for a lot of people.
Yeah, I agree. Look, I'm fairly allergic to these kind of attempts for government to shift behaviour with these blunt tools. I mean, the whole trying to force pension funds into illiquid private equity. I'm allergic to that. Telling people what they can and can't do with their ISA holdings.
You're basically allergic to government.
No, not at all. No, I love government, and I think government can do some great things. And I think actually, when we had the nudge unit for the period that we did have the nudge unit, they were doing some good things. But you've got to nudge people. You can't say, look, we're going to cap this, we're going to cap that, we're going to tax this. It's not, you can if you're trying to raise revenue. That's absolutely fine. I don't object to that. But you need to nudge people gently and cleverly. And I'm not seeing much of that. I haven't seen much of that for several years. That's not party political.
And the problem we've got is that, when the market's in decline, it's all over the news. And when it's in positive territory, we don't hear about it. So that's the messaging that's going out to the general public. We need more positive messages going out there about the long-term benefits of investing.
Yeah, that I find the biggest challenge, actually. We've made it so easy, or much easier, for people to borrow money than to invest. We scared shitless, we scared people shitless about investing. We've covered everything in disclosure and, caveats and all these things. I'm sorry, the average British investor even isn't well educated or given any confidence, to be long-term investors, unfortunately. If we can find a solution to that, and you do see green shoots, for instance, Martin Lewis, for the first time in a very long time recently, did a piece on investing. I saw a chart that he put on, something about 10-year performance of different asset classes, cash, equities, and things like that. And he said something like, 10 years, long-term equity return. I'm thinking, 10 years long-term? No, that's not.
Do you know what though? That was brilliant, because he's a voice that isn't a financial advisor that people listen to. He's always talked about debt, managing your bills, cash. For him to come out and say, look, actually cash isn't the way to make a good long-term return, was great. I was slightly disappointed. There were a few people from our profession giving him a bit of a kick because something on the chart wasn't quite right, or he mislabeled.
We do that.
I mean, it doesn't matter. His fundamental point was a really positive one to a broad audience. So,
Absolutely. It's
think
about
it's
the
great.
messaging, isn't it? And, the panel that were on there as well, well-respected professionals. We had the regulator on there. We had the vice president of the PFS on there. We had, it was a really good, well-educated panel giving positive reinforcements to the general public. And that's what we need. We need to increase public trust in investing.
100%.
More of that, please. More of that. And then we are moving on to what is...
Well, listen, I'll tell you
This
what,
is your
before
topic.
you move on, you were talking, so you pulled the pin on the active versus passive hand grenade. So we need to talk about Mr. Smith, I think, surely at this point. We've held off for half an hour in the podcast. I don't know if people saw it, but another letter to his investors, another year of underperformance. I think he's underperformed now. It's not just, he's been really underperforming the last 5 years, but I think actually the last 5 years have been so tough on him that now the last 11 years, I think he's underperformed, the passive equivalent to his fund. And his end of year letter, I thought did give me a bit of a giggle, because he was blaming passive investing this time for his active management underperformance. And this seems to have done him much harm from a fees and a lifestyle point of view personally. But yeah, apparently passive investing is going to bring around some kind of Armageddon, and it's prevented Terry Smith from even performing in line with the index. Explain.
Carla, this is where we lose you.
Indeed.
No comment. Okay, that's fair enough. I'm just interested in Abraham's view. I mean, obviously, Abraham fundamentally is a passive junkie is apparently part of the problem. The reason why direct-to-consumer clients have been suffering massive underperformance with Mr. Smith. So, Abraham, it's your fault.
Well, this is the thing. I actually like Terry Smith because he's, like a long-term investor, very pragmatic, holder of equity and all these things. I really like him. Not enough to pay, I don't know, 70, 80 basis points to hold some sort of global equity fund. I just would not, or UK equity fund, But again, you're absolutely right. I mean, it's the gap in his performance relative to global equity now is just so high, so untenable. I do think that we are at the point where, he's at the point where, unfortunately, Wood was before everything just turned to dust, basically. So I'm sorry, Mr. Smith, you've probably passed your sell-by date. But this constant thing, right? This thing that you see, active managers do, which is to blame index investors for, frankly, anything, just doesn't make sense if you break it down to like the simplest form. Index investors, we are price takers, just like, frankly, every consumer is. I don't go to Tesco's and try to haggle my way. I don't go to Sainsbury's or for most things that we buy in life. If you're buying very expensive or high service or whatever, you can haggle. But, in free capitalistic society, we buy things and we trust the power of capitalism to set the price. So in this equation, it is active managers of all kinds, retail, institutional, pension funds, what's the word? High trading, high frequency traders. They are setting the price. As an equity investor, as an index equity investor, we're just buying the price. I have no opinion on whether the price is right or wrong. I just accept it. So to suggest that for some reason, because we are putting money in this market, we're buying, to suggest that distorts price in some way or another, it just doesn't have any leg to stand on. So, and I think he doesn't himself, much more damage. I don't think any sensible investor in his fund buy this story anymore. And the good thing is there is only so many years that you can keep telling this story. The bad news for these people is they are so far behind that to catch up and turn this around,
it's impossible.
Yeah. So, So is that good enough for you?
Yeah, that's good enough. Look, I like the guy as well. And, and he's one of the few active managers who will actually explain his thinking and his process, blah, blah, blah. I just think, come on, man, just say, look, I've got the calls wrong for the last 5 years. I'm damaging your returns. I'm really sorry. I'm going
to close the fund. I'm going to close the fund and give you your money back.
Absolutely.
And
I've got my yacht, right? So, and, I can just retire.
I'm going to retire to my ranch.
With these staff fund managers, don't you? They're great for a period of time and then the performance starts to wane and it's knowing when to stop, I think. But, with any service, if you will, if you're paying a fee and you're delivering underperformance, it's not good.
Yeah. 100%.
Anyway, so I think that brings us to the end of this episode of Soapbox. I hope that you've all had a good time listening to us. If you have any thoughts on this discussion or any topic that you think we should talk about, ping me an email. Mine is abraham@timeline.co. Carla, you can tell us your email if you want people to get in touch about
please do. It's carla.brown@thepfs.org.
And if you want to send insults, you should send it to
send them all to me.
I don't want
Send them all to me. It's matt@outdoorwealth.com. I'll take all the brickbats and criticism.
Good stuff. Guys, thank you very much for your time. Thank you for your wisdom. See you next time.